So we're in Tel Aviv, and we're with a special Angel edition of our show. And my guest today is Liron Rose from Rose Innovation. Did I get this correctly?
It's totally correct. Hi, Ofer. Good morning.
Hi, how are you? Are you ready to take us into your insights?
Absolutely. Let's get to it.
All right. So, Liron, what does Rose Innovation do? And how do you make money?
Okay, so Rose Innovation is basically my company, which I use to invest into startups. So what we do is we look for startups. We kind of work with the ecosystem here in Tel Aviv. We review pitches that we get from startups, evaluate companies, and then, if it's interesting, we get into meeting them. We usually connect them to additional investors as well. So we try to lead a group of investors and basically come together as a team and make an investment seed round or A round, so forth.
All right. And what's the typical check size that you guys write? And what type of percentage are you looking to get, or equity are you looking to get back from it?
So it's kind of like I used to write $100,000 checks as an angel investor, but these days we usually come as a group, as a larger group, try to, anything between $1 to $2 million as a larger, basically a group of investors. So we try to get to, double digits as investors into the cap table.
After Downloads, that was the company that you founded.
Yeah.
Tell me a little bit about the backstory here, the story of After Downloads, and what got you into angel investing afterwards.
Okay, so actually I got into angel investing before founding After Downloads. I started with angel investing in 2006. And the first company I invested into was Kenshu, which is this platform that used to manage pay-per-click search engine marketing. So these guys are around 500, 600 people these days, half of them in Israel, and the other half is in offices all over the world. And I also did SimilarWeb. That's before founding After Download. That was in 2009. Again, it's another company that does internet ratings. It's basically I would say the biggest rating website or platform over the internet. These guys are also 500, 600 people these days, and valuation is almost $1 billion now.
Wow.
So these companies I did before founding. Now the founder story behind After Download. So I used to do online marketing for quite a few years. I started this in 1999, so very, very early in the internet, into the internet days. It picked up around 2004, 2005. I used to do online marketing, search engine marketing campaigns for software companies. Back then, it was Google AdWords, was the main traffic source. We also had Yahoo and Microsoft Bing. Facebook wasn't there yet. And then Google, they had these policies and compliance teams, and they started to make our lives more and more difficult with marketing. And we kind of thought, this is something that we can rely on for the future. Google's making our lives harder. We need to find some sort of solution to kind of aggregate traffic sources and have have our customers, the software companies we're working with, rely on us. And if we could do this in such a way that our traffic is as good as Google's, these companies will come to advertise with us. They're used to doing pay-per-click. So, and Google's making their lives hard, they could do this with us. So we established this company, and it went really well. We had customers, because we knew them before. Mm-hmm. The challenge was to get more traffic sources. So we have really good traffic to sell. So the name After Download comes from the post-download page. So if you say you download Skype, and, you have a thank you page, thank you for downloading Skype. Google's policies prohibited advertising on that on that page, and that's where the name After Download comes from. So we kind of our first ads were placed on this kind of on there.
Got it.
Yeah.
And so after the acquisition of After Downloads, essentially then went back to angel investing, right? So it didn't get you into angel investing, you just
exactly. Yeah, that's right. So After Download grew from 0 to 50 people in 3 years, and then it got acquired by IronSource in 2013, I think. for around $30 million. And yeah, I went back to angel investing. And I think like 1 or 2 years after that, I also, I got kind of recruited by an American company by Techstars. So they are this huge company that does accelerators all over the world. I think running like 40 or 50 accelerators. And there was like, they had this vision of establishing one here in Tel Aviv. So I ran their operations here for 2 years. And, that's kind of how I got into fintech as well. Before that, I used to do mostly ad tech, marketing tech, SaaS, B2B, B2C, and like doing this accelerator for 2 years, like, interviewing hundreds of fintech companies and accepting 20 companies to do this with us. Kind of got me into fintech as well. So we did 20 investments in the accelerator.
So if you look through your angel investing career, what are some successful investments that you were part of?
So I would say, SimilarWeb is like really, really good. It's like 20x or even more. It's kind of really, I sold some of my holdings throughout the years. If I would have kept everything, it would probably be like 80x now. Kensho was good too. Kensho is a very successful company, so Kensho did well, and that's another good one. Another story is, this fund called Circa. So like in Circa, it's a late stage fund or like a growth stage fund. And that's kind of from the last 2-3 years. And we had, we had Armis Security. It's like this unicorn. We had Fiverr, which did an IPO. It's like unicorn now. We had Datorama, Demisto, Dynamic Yield, and Adolom. We had a bunch of them. So we had like 9 exits out of 18 investments. That went like really, really well.
What is it like to have like a life-changing event, an exit with after download?
So for me, it wasn't like such a life-changing event in per se. I kind of did this online marketing campaigns for years, and some of them were like really, really successful. So I kind of got used to, making a good income before for quite a few years. So like doing this company after download and like selling it, it didn't like change my life like overnight. I kind of got used to this before. But anyway, it was kind of, I would say that like the peak of my career in ad tech per se. So that was kind of, I did everything I kind of could in that particular vertical. And, when the company got acquired by Ironsource, I said, okay, I'm going to move away from ad tech and do new things.
So it's a personal achievement.
Yeah, exactly. Yeah, exactly that. Perfect. Yeah, totally.
So everybody knows we have angels, we have VCs, we have accelerators out there. Can you give us maybe just a glimpse into what are the differences between those and how they interact with each other?
Yeah. So basically, like you have a startup, people want to start a company and they want to seek funding. So like usually the first thing they do is they go like to what they call FFF, friends, family, and fools. But that's kind of limited. So you kind of raise 50, 100K from these guys, and then it's not enough to do anything, and you're trying to get more of an outreach. So first, like you have two options. VC funds usually don't do like pre-seed. So you either go to accelerators who are in the ecosystem, like that's kind of their role in the ecosystem, and the other option is angel investors. So you either go and try to raise from angel investors. In Israel, you also have the innovation authority, so you kind of get some help, some fundraising from the government as well. That's another possibility. If like into deep tech, they would help you too. But other than that, accelerators are kind of easier because they kind of put you on this path to improve your pitch, make your marketing materials, investor materials like better. They kind of get you connected to the entire ecosystem. They can make you introductions to angel investors. Whereas if you don't do an accelerator, you kind of have to figure out everything on your own. So you kind of have to use your own sort of hustling abilities and get in contact with those people, like hustle people on LinkedIn or get introductions through people that and kind of get yourself connected through the ecosystem. So you either do this on your own if you're like really good at sales, or if you kind of need help with that, an accelerator would probably be the solution for you.
What kind of differentiates the angels from one another?
Right, that's a really good question actually. So you have like tons of angel investors, and these days we have much more than what we had like 10 years ago. I think angel investors, angels are not just people who can write a check, right? So some of the angels are more kind of what you call smart money. So these guys would kind of come from an industry and will have some kind of domain expertise in a particular industry. So if you get that kind of an angel on board, like someone who's like the VCs or have like high respect for, so that means something. So if you kind of get an angel that had previous successes on board, you both kind of get a few things out of this. Like you get the funding, you get the money, but you also get like a smart person on your team, on your side. So this person who is now kind of someone that's on your team and will kind of help you to get more investors, to get more introductions. He will kind of help you and invest his own time with you as a founder and kind of improve what you're doing and help you push you to the next level.
What type of companies are you investing in today? So as an angel investor, I know you're also doing some investing through the funds, but as an angel investing, then what type of companies do you look for today?
So I would kind of say this is like COVID-19 year. We're filming this in July 2020. So, these times is kind of a peculiar times for investing. I said a long time ago that 2019 was kind of hard for angel investing because all the valuations were so high, and these days, it's much harder for founders to raise money. So I'm kind of looking into these opportunities more now than what I did, say, like a year ago. In terms of verticals, if that's what you're asking, so I'm kind of looking into SaaS. I'm looking into marketing tech, B2B, B2C, enterprise software, fintech. So, I'm kind of looking at my own sort of track record and successes, and I kind of see that, the closer I am to the domain that the startup is actually active in, and, my success rates, my hit rate is higher. So, something like if a biotech company or an automotive, say autonomous cars or cyber security, this kind of stuff, I'm not a domain expert with. So, if something like that would come through, so I'll probably have to ask someone else. So I will not be able to lead around. I'll probably, I'll refer them to, a domain expert and say, go to meet this and this person.
Yeah.
He'll probably kind of have some feedback. And if these guys, if these people like you, come get back to me, I'll talk to them and we'll see what we can do.
What type of return are you expecting as an angel? I mean, you put in X. Are you looking for what type of multiples? We know VCs usually go for 10X mostly.
Well, the first rule is like, don't lose money. And the second rule is like, don't forget the first rule, right? but with these angel investments, you kind of expect like 9 out of 10 companies to go out of business, especially if you're doing pre-seed. So you kind of expect to lose most of these investments, but then you need this like one outlier that will cover all of your losses plus leave some profit. So you kind of need, if you're going pre-seed or seed, you probably need like 10x, 20x or more.
So if you zero in only on the success ones, you're looking at 20x?
Yeah, because if 9 out of 10 companies eventually go out of business, this is kind of the general statistics, and maybe my personal hit rate has been higher. But you never know if that was kind of because I'm a better investor or it was just I was lucky. You never know that. Yeah. So you want to keep that. I want to keep that hit rate as it is, as good as it is. So 9 out of 10 companies go out of business and basically fold. So you need that one company that is successful to cover for 9 companies, and you want to make money as well. So you kind of need like 20x, I would say. Sometimes if you're good at what you're doing, and you can 2 companies out of 10 will be a success. But usually when a VC fund, they usually need this kind of, and it's the same for angel investors. Like a big VC usually needs a unicorn to return their entire fund, and then they maybe have another exit for $100-200 million, and that's okay. But without like a huge success, this is not a viable business. You rather you can invest your money into the stock market and go Facebook, Amazon, Apple, Google, and make a good return that way. So if you want to do angel investing or venture capital, you really need these outliers, and this is how you kind of make money.
having done both founder and angel investor, even a type of a VC thing, what is the difference or the main difference that you see between founder and investor?
Okay, so it's kind of it's a totally different animal, I would say. A founder needs to be really, really focused on what they're doing, and it's like a one mission sort of team. So if you are a founder, it's like going into war, or it's like trying to climb the Everest or something like that. You have to focus your entire energy into your project against all odds. There's so many reasons why your startup will not succeed, and for it to succeed, you kind of need to everything to work well. So as a founder, I would say you need three things, right? You need one, do something that you really like, because if you don't, then you'll face too many difficulties through the way, and then you'll give up. The second thing I would say is do this with people that you like, because you're going to spend a lot of time with these people, with your team. So I would say if there is this person that you can't spend 4 hours with on a flight connection somewhere, it's too much, then probably that's not the right partner for you. You need to do this with, it's like getting married. So this person, this co-founder becomes your partner for this entire voyage, and and the third thing I would say is kind of critical, and I've seen lots of companies succeed on that point. If you're try to solve something that's kind of a problem you're facing personally, don't try to kind of reinvent the wheel in something that's totally unrelated to you. You're having this problem, I don't know, there's something you need, an app that kind of will do something for you, and you try to find across market, like the App Store, and you don't find anything that's kind of solving that. Probably you are in good company. There's thousands of people just like you who have the same problem or the same need. So if you solve this, you're probably getting yourself into a niche or a vertical or some kind of gap in the market. Whereas if you're trying to, I'm going to do a startup, let's solve this problem, but this is totally unrelated to you, probably your chances of success are lower.
From a stress perspective, founder, investor, who has more stress?
So I would say and I'm not the only one saying this, founders are the most important people in the ecosystem. Everything else relies on founders. So you can't have investors without founders. You can have founders maybe without investors, if they're bootstrapped. So everything relies on the founder. The founder is this kind of, he's the person on stage. And the investors, they can be helpful. They can be unhelpful. They can be, challenging to manage. They can be many things. And I think a good founder, a good CEO, he knows how to handle his investors. It's not a good idea when investors kind of tell the CEO what to do. So the CEO needs to be confident enough that he knows what he's doing, and he's going to tell the investors, look, I'm going to go that way, and I'd like you to join me on that road trip. I want you because you're smart and you're from this domain, and you have this kind of respect in the ecosystem, so I want you on board. We can do this together. And then the investor kind of can analyze this and kind of think, okay, I want to join this founder on this thing. I love this guy, and I'm kind of impressed with what he's doing. I'm going to join or not. Whereas this founder who's kind of always looking for an approval from investors, what do you think? Should I do this or this? This kind of founder, no. So you want to have, you want to kind of be able to manage your investors, your board members as a CEO. Yeah.
Do you miss being a founder?
Wow, that's a really, really, that's a good question. Look, being a founder is super exciting, right? Because you kind of invent something out of nothing. It's 0 to 1. So basically there's something that's nothing, and there's something that's not existing, and basically you make it happen. It's exciting. You kind of go on this huge trip. with partners, and then you grow. If you're successful, like after download, you kind of grow the team. You have people joining you, kind of develop organizational sort of structure and culture, and make something in the world happen, manifesting it. It's like it's super satisfying in such a way, kind of being creative. Investing is something else. I'm not, it's more of, it's a lot of saying no to people, kind of get all these leads and deal flow, and kind of, okay, you have to analyze it because, no one has enough money to invest in everything that comes through. So kind of have to be like really selective, and it's kind of saying, no, I'm sorry, and this is not good enough. And so in some ways, I kind of miss being a founder. In other ways, in terms of, I would say, kind of more of a work-life balance. I would say like being an investor is maybe a little bit easier because it's not that you don't need to kind of be totally immersed in the business. Whereas as a CEO, as a founder, you kind of, the business is you, and there's like no escape.
And do you feel like you have another inning in you? Can you see yourself being a founder later in the career?
It's possible. I'm never saying no. Right now, I'm kind of happy with what I'm doing. I like what I'm doing in terms of, being in the ecosystem and accessing all these like great opportunities. Managing my own calendar and being in control of my day to day. If I ever go back into like founding a new company, it has to be like something that's super exciting because I know how committing it is. Yeah.
As an angel, you have your portfolio companies. What kind of KPIs are you obsessed with? What are the most important KPIs that you're watching with the portfolio companies?
So when I kind of meet with new companies or even companies that are already in my portfolio, I'm looking at two things. One, I want to see traction and I want to see like revenue. So when I invest in the companies, I'm kind of more looking into companies that kind of create revenues, whereas there's this other type of companies that kind of build technology and get acquired by Google or Amazon for $100 million without having $1 of revenue. I'm not into this kind of, it's harder for me to evaluate this kind of companies. So I'm going to the ones that do have revenues. And I want to see the revenues, growing double digits month over month. So, for a startup to succeed, you kind of need to get into critical mass, which is, like a few $1 million of ARR, like annual recurring revenue, if not like tens of millions, right? The only way to do that is like grow, I think, like 3x from year to year, especially in those like beginning like five earliest years. So you want to grow 30%, 300%, like 3x year over year. And if you kind of reduce that into month over month, I think it's like 15% or something month over month. So if a startup is not growing like, like 30, 40, 50% from quarter to quarter, probably they're not gonna like make it to being a huge success. So that's kind of, and it's not easy, it's easy to say, it's very, very hard to execute that.
How involved are you in the portfolio companies? So are you really hands-on? Are you totally hands-off? Are you somewhere in between?
I would say that it's kind of depends on the stage of the company. The earlier, like if it's a very early company, it's like the small team, then usually the founders, they kind of want the investors to be more involved. They want the investors to help them with introductions, with business development, with opening doors. Whereas like the more advanced a company grows, say like 50 people and more, then usually they kind of need less help from you, like on a day-to-day basis. So they will still come to you and, can you help me with opening a door here and there? Obviously, as an investor, it's, you want to do that. But they will not come to you on a daily basis because, they're already kind of established and they know what they're doing. And they're kind of already like focusing on a specific market, which as an investor, you don't know better than them. So you want to be kind of available to your founders throughout the entire journey and kind of help them when they need you.
From your experience, having experienced both an exit as a founder and exits as an investor, what's the difference between the two in the feelings that you get?
It's another great question. When you do this as a founder, it's kind of your creation, right? So it's kind of an artist that makes a masterpiece, and then it's kind of in this like tier 1 museum wherever, an exhibition, and everyone's kind of clapping hands and wow, you're like this rock star. As an investor, it's also it's the success is different because it's a financial sort of achievement. It's a professional achievement. You like really makes you proud in your decision making. But it's kind of similar in some ways to playing some sort of a game. You have this like entire chessboard in front of you, and you can move the pawn to this place and the bishop to that place, and maybe, okay, let's wait and let's not do anything. Let's wait for the opponent to do something. So it's more of like this game with multi-dimensional sort of possibilities, and it's kind of you get feedback from the world on your decision making. So if you make the right moves and you make and you invest into the right people, so you basically you made good decisions. So you get feedback, and kind of that's okay, I know what I'm doing, and I'm going to keep doing this because it's kind of fun. But it's not your creation. It's not
you're less emotionally involved.
Yes, it's not. Yeah, it's not your sort of piece of art. That's kind of an exhibition. Yeah.
When should a founder, at what stage should a founder approach someone like you or another angel? At what stage of their company?
Okay, so I don't think it's about stage of a company. It's about how to approach, and I think lots of founders don't get this right. So it's probably better to approach someone like me through an introduction, like a mutual friend or something, or mutual contact over LinkedIn or Facebook, because it's kind of a warm introduction is better than cold calling someone over LinkedIn, obviously. But I'm not saying that approaching me directly, even if you don't know me, is a bad thing. If it's done in a right way, it can be very, very appealing. I get anything between like 5 to 20 cold emails like this every week from founders who are approaching me, and it's not about the stage where they're at, because if they are in a more advanced stage, they have more to show. They will be able to show numbers like revenues. They will be able to show customers. But obviously the valuation will be higher because it's more of a, it's a later stage company. But it's kind of it's when you write this cold email, and if it is a cold email, would be like really, really specific and make yourself stand out from the others. So I don't really need to, know all of your life story at that stage. What I kind of basically your email is trying to intrigue me to reply to you. Okay, I want to learn more. So it's either a very, very good presentation. It could be visually, so wow, these guys, it's like kind of intriguing to see, it's kind of impressive what they are doing here in terms of presentation. Or it's the numbers, wow, these guys are growing really, really fast. That's interesting. I want to see. I want to see more from them.
So it's more about sparking an interest.
Yes, it's more about sparking an interest and kind of standing out, because, if I get 20 cold emails every week, and I have to choose 1, 2, 3 that I will, reply to and maybe engage further into a phone call or into a meeting. You have to be like really intriguing.
For founders out there trying to or thinking about selling their companies, what do you think today are okay valuations to expect so that founders don't think, I don't know.
Yeah.
What are realistic evaluations today?
Okay, that's another great question. I'll kind of limit my answer to SaaS companies, which I'm more kind of familiar with. So I've seen I've seen anything between a multiple of 7 to 12 over your ARR as kind of a benchmark. So yeah, if you're like making, $20 million ARR, then you kind of could expect the valuation to be, around $200 million, right? So it could have been a little bit more maybe in 2000, like last year. And like these days, COVID-19, maybe it's kind of on a lower end of the spectrum. But then again, it's also depending on the growth rate. So this multiple, if you're like still growing at 20 and at that stage, like when you're like $20 million ARR, you can grow at 3x. That's it, kind of impossible. So if you're like growing at 30% year over year, or 40%, that's kind of what makes the change in the valuation. So if the acquirer, the purchaser, sees your growth rate and they say, okay, wow, these guys are growing at 40%, 50%, yeah, I'm comfortable paying 12x ARR. Whereas if you're only growing at 15 or 20%, they might say, look, you're not growing fast enough. Yeah, we still want to buy this, but we're going to pay like 6x, right?
In your opinion, what's the next hot trend for founders? So what if you would be able to advise a founder thinking, or a potential founder, what vertical should they go in? Is it like AI, e-commerce?
Yeah. Okay, good question. So if you would have asked this 2 years ago, then everyone was all over blockchain. But since then it has changed. And then I think last year, everyone was like, still, like everything that comes, every deal that I see has the terms AI as a buzzword everyone's doing AI. So kind of this buzzword is now got out of fashion. Still AI is like super important, right? But you don't, it's just a buzzword for most of these startups. So if I have to kind of think of what's kind of hot now, so it has to be somehow related to this COVID-19 situation, right? So like the world is changing in front of our hands. The airplanes are grounded, retail stores and offices are kind of, out of fashion. People are staying at home. So, you've seen this trend that anything to do with remote working is super popular. So again, this is something that you could have started a few years ago if you were like Wix or Monday, or Fiverr, like these companies. Yeah, it's too late to start them now, right? But you kind of have to think, okay, what's kind of the next thing? Okay, maybe this COVID-19 thing will be solved in a year or two. We don't know. So you could start and work on a vaccine, which like thousands of companies try to do. But I would say, what's the next thing? And I think e-commerce is here to stay. So, all of us kind of got used to the idea that, you do your shopping online more than what we did before COVID-19. And I don't think this is going away. So even if, we're going to find a vaccine to this, still, we kind of got used to the idea that we can kind of order everything online. We can kind of type into our WhatsApp, and the fruit and vegetables will be at our doorstep. So before that, we probably were used to going to a store and picking up some stuff. We still did some e-commerce, but I think the percentage of e-commerce is now much, much bigger. And I don't think this is going away because it's like very, very time efficient for us. So anything to do with e-commerce and distribution chains, last mile distribution, this kind of stuff, I think this is gonna stay post COVID-19 as well.
Do you have any tips for ex-founders doing their first steps in angel investing? They have a saying that angel investing is kind of how you lose your fortune. So if you already had your exit, and you made a few $1 million, and maybe it's a good idea to stay away from angel investing if you don't want to lose the entire thing. So no, I'm joking. So it's kind of I would say the way it worked for me, right? So you want to stay as close as you can to your area of expertise.
Exactly. So yeah, you want to stay there because that's where you kind of know the kind of the competitive surroundings the best, and if someone approaches you with a new product or with a new startup, you kind of know intuitively if the chances of success. So, and you will be better at judging this than some other investor who is not from that domain. So your chances are higher. Again, it's a lot of angel investing and investing in general. It's a lot of it's a probability sort of game. If you can do this like 20%, 30% better than others, then you're in the game. And the way to do this is kind of to stick to the advantages that you have. So if you don't want to invest into startups necessarily of your best friends, because maybe they're doing something totally different, so you could end up like both losing money and your friend, right? So you don't want to do that. You want to stick to doing this on a professional sort of level. Stick to the domain, to the domains that you know well. Ask lots of questions. Probably do this with co-investors that you kind of have high respect to. Maybe people who've been doing this for longer than you, because they've seen more. And if they're jumping in, maybe that is a good sign. So yeah, be careful. If you have all of a sudden you have a bunch of money, don't spend it all on angel investments.
Got it. Any kind of your golden tip for new founders just starting out on how to succeed?
Wow, there's so many factors in. I think choice, like the choice of co-founders, right? The team. I think we're in a people's business here, and anything that happens because a particular team has created it out of nothing. So you want to be really, really sure. Who you're choosing as your co-founder, and I think I've seen people doing this with people that they don't know well. They met someone at a meetup, and they were looking for a co-founder, and they went to all these meetups, and they're starting dating this co-founder, and after 2 or 3 dates, they say, okay, we're going to do this together. It's basically, making a proposal, like a marriage proposal after the 3rd date. You probably want to see, it's probably better, to live together for a while and see if things work. And you can do that with new people that you've just met. So I think sometimes I've seen good teams coming out of people who know each other for a while. The advantages, and and you kind of know the strengths and the weaknesses of your co-founder. So this is kind of a complementary team. You want to be with someone that's kind of better than you at some things, and you obviously also accept that at some things you're better than him, and that's okay because you're covering for each other. You don't have to be exactly the same. But yeah, you rather do this with someone that you know well and trust, because there's, you're going into bed with that person, and you're going to be with that person for 7 or 10 years now. So yeah, make that choice carefully.
Thinking back about the hundreds or thousands of pitches that you've heard through the years, which one stood out? Funny one, an interesting one? Which is the one that's most memorable?
Yeah, when we did that, when we ran the accelerator back in 2006 for Techstars, I had this guy that came all the way from Tel Aviv. He came from London. He came from London to do the accelerator in Tel Aviv, and I think his pitch. I think it ended by the term world domination or something like that. He kind of shocked the entire audience. It was 350 people in the hall, in the venue, watching demo day, and this guy went all in with his pitch, and wow, and people kind of clapped. I don't know if his startup succeeded more than others, but sometimes again, it depends on the situation. Sometimes you kind of need to stand out and make a big impact. In other cases, you know, if it's not the right thing to do, then people will look at you as a clown, you know. But for that guy, it worked well.
And then knowing what you know now, do you regret selling after downloads at that point that you sold it? Would you have done anything differently today?
Good question. So when you sell a company, you know, it's not an easy decision to make. You know, you think, okay, should I do this like on my own? You know, like as a team, should we stay together as a team and grow this business for another 1 or 2 years? Maybe we can do this on our own and maybe then get acquired for more money, right? Or should we kind of you know, capitalize on the opportunity right now? You know, take, you know, like one bird in the hand rather than 2 future birds that maybe we won't get at all. So, you know, it's kind of an emotional roller coaster. You kind of never. Sometimes you think that you kind of sold it for too cheap. Then the market situation kind of changed, and they said, "Wow, I'm so lucky I sold it for that kind of money because I wouldn't get that offer these days." So, you know, you kind of never know if you sold at the right price, but you kind of have to make that decision. So, okay, I'm going to sell or not. So what we did, and I think that was kind of you know, kind of the golden sort of path. We got an offer, and it was kind of a mix of both cash and some equity at a company that bought us. So we got our kind of share in cash, so, you know, kind of made us comfortable. And then we also believed in the future of ironSource. We also believed at the leadership of ironSource, and, you know, that piece of equity that we got, you know, over the years, the ironSource grew by a lot. So that kind of made it the right. I think that was kind of the mix was kind of the right decision for us, like, for the offer to accept it.
And then final question, what lies in your future? Are you starting a VC fund? Are you staying more in the angels part?
So right now, you know, I'm kind of looking at where we are in terms of the ecosystem here in Israel in COVID-19. So we have to see how the market's going to respond to this. You know, this year has started. Yeah, Q1 was like extremely strong in terms of fundraising, but then we had, you know, Q2, and now we're at Q3, and it looks like the situation's gonna kind of not get easier necessarily for these startups, especially for the you know, for seed and round A. It's gonna be tough for these guys. So I'm not sure it's I'm gonna start a fund within the next year, but I'm definitely, like, you know, looking into the market, you know, because there's going to be like really good opportunities from companies that, you know, are finding it a little bit harder to raise money right now. So investors could get really good deals 2020 and 2021, deals that were impossible like just a year ago.
Well, thank you, Liron. It's been a great pleasure having you on the show.
Thank you. Thank you,
you're an inspiring person. Thank you so much for taking the time and being the guest.
Thank you so much, Ofer. Thank you for having me.
COVID bump.
COVID.